Hi everyone, my name is Mark Quinn. I'm a tax advisor and financial planner based in Portugal, and in today's video I'm going to talk about the non-habitual residence scheme, but specifically the planning you need to do around membership of the scheme. So most people have heard of the non-habitual residence scheme in Portugal, but if you haven't, it's a 10-year tax incentivised scheme designed to attract new residents of the country. And whilst many people know about the scheme, what a lot of people that I speak to don't appreciate is the planning that you need to put in place around the scheme. And I break this down into three different stages. There's the planning that you need to do before you arrive here in Portugal. There's a planning that you should be doing whilst you're a member of the NHR scheme. And that planning should be concentrated on future-proofing your affairs so that by the end of the 10-year NHR period, your affairs are still tax efficient as a standard taxpayer in Portugal. So the first planning steps you actually want to be taking actually start before you even arrive in Portugal. So you want to be utilising any tax breaks in your current country of residence prior to arrival in Portugal and entry into the Portuguese tax system. So if we think about it from a UK context, you want to be utilising capital gains tax allowances. You also want to be making any contributions that you can make to pension schemes and enjoying the tax relief that you get on those contributions whilst you're still in the UK. And another step would be to close down any individual savings accounts, because whilst they're tax-free in the UK, if you defer that until you become a Portuguese tax resident, then any gains that you realise within the ISAs are seen through by the Portuguese tax authorities and they're taxed at a flat rate of 28%. If you're currently living in countries such as UAE, Singapore, Sri Lanka that don't have capital gains tax, again, think about closing down any investments or structures that have capital gains in, because you can do so tax-free, which again, you can't when you arrive in Portugal because you have capital gains tax at a flat rate of 28%. And again, if you're coming from a UK background, then consider taking pension commencement lump sums, which was formerly called tax-free cash. It's your 25% tax-free cash entitlement, because if you do that when you're here in Portugal, even under NHR, you're going to be subject to a small element of tax on that lump sum. Another crucial part of the pre-arrival planning that you need to be thinking about is also making sure you have a clear understanding of the residency rules of the country that you're leaving, so that when you do leave, that you make sure that you've clearly detached from their tax system, and so they clearly have no rights over taxing your income and your assets. So if you look at the UK, for example, their rules can be quite sticky and adhesive, and it's quite easy for you to fall back in their tax net. And I've done a separate video around this. It's crucial to have a very clear understanding of the UK Statutory Residence Test 2013. If you need any help, just let me know. Other countries have a similar situation. So if we think about Ireland, although I'm not an expert on Irish tax, my understanding is that in some circumstances you can be considered tax resident after leaving Ireland for a further 3 years. So again, just make sure you have a clear understanding of where you're coming from, and making sure you've made a clean break from that tax system. So just moving on to during the NHR period, the first thing that you want to be doing there is actually maximising pension income. So this is a good example of the timing differences. With tax-free cash, you want to be taking that prior to departure from the UK, whereas conversely, the income from a pension scheme should be taken as a general rule when you arrive in Portugal, because you're going to be doing so at a much lower rate as a general rule. The only caveat there is that you've got to balance the tax efficiency of pension income versus the inheritance tax efficiency of having money within the pension scheme, because it's always outside your estate for inheritance tax purposes. The other point you want to be thinking about is establishing structures here during an NHR period that are going to be effective and tax efficient beyond the 10-year NHR period. And there's certain structures that you can be using from as early as 2 years into your 10-year NHR period, so that by the end of the 10-year point, you've got a really efficient tax structure to use beyond the end of your NHR. If you're taking salaries from a UK company, for example, you may want to review your remuneration strategy, because under NHR, dividends are actually tax-free, whereas salary is subject to tax in the jurisdiction you perform the work. So if you're living here and working from Portugal, the salary will be taxed here even under NHR. Just bear in mind that with all tax planning, especially cross-border tax planning, there's various nuances to the planning, and in some limited circumstances, it's actually better not to apply for NHR, and I'm going to be covering that in a future video. If you are NHR here already and you qualify for the pre-April 2020 scheme, which gives you 0% tax withdrawals on pension, again, the planning is subtly different to somebody coming in after April 2020. And as a final point, if you're a non-UK domicile, so if you originate from somewhere else other than the UK, then again there's other issues to consider around domicile and how that interacts with tax residency status. So I think the message is clear. Always seek advice from a tax advisor and a chartered financial planner that understands both the UK and cross-border tax matters and is familiar and experienced in Portugal. I hope you found this video useful. I'd be grateful if you did, if you could just press the like button and also subscribe to the channel. That would be much appreciated. And I look forward to seeing you soon. Thank you.